long put Christmas tree spread variation, which is a very cheap strategy that could net you 600, 900, 1000% returns. So firstly, before you ever enter any options trade, please make sure you know how to close it. I'll pin a video in the comment section below where I show you guys how to close out of any options trade. Now let's first start by talking about our goal here today. So our goal with this strategy, first of all, this is a neutral strategy, meaning that we want to benefit from sideways movement in the underlying stock with limited risk and for very, very cheap, sometimes $2, $3 is all you need to enter one of these strategies. And so the ideal situation here is you believe a stock won't move much up or down. It will basically stay within a pretty tight range in terms of its share price, and you'd like to take advantage of that. I'm going to be using ticker symbol RIVN, Rivian Automotive, for today's video. Again, this is just an example, so don't copy this exact same trade. But before we go into the options here, again, two very important things we always need to check. Number one, commission fees, especially with this strategy, guys. This has a lot of contracts that we're opening and closing. So if you're on a broker with high commission fees, that might eat away at a lot of your profit. Now, Robinhood doesn't have any commission fees, so we don't have to worry about it on here. Number two, we are going to be selling options. Anytime you sell an option, there is risk of assignment. We want to avoid being early assigned due to the ex-dividend of a stock. So you should always check, does the stock have a dividend? If it does, when is the ex-dividend date? You want to avoid selling options on the week of the ex-dividend date. If you do sell options that week, you want to close out 2 days before. So remember, we can always go to NASDAQ.com and search for whatever stock we're using. So we are using ticker symbol RIVN. So we'll search for Rivian here, and then we'll find Rivian on here. We can click on Rivian, and then on the left, we can click on dividend history here. And then again, this will show us, does this stock have a dividend? And if it does, when the ex-dividend date is. Now, Rivian doesn't have a dividend, and it's going to tell us here that there's no information. So once we've checked those two things out, we can actually go into the options for the stock and talk about this strategy, how it works, and how you would set it up. So let's go into the options here. Now, number one, you do not need to own 100 shares of the stock to use this strategy, nor do you need to have enough money to potentially buy 100 shares of the stock to use this strategy. Okay, you just need to have enough money to pay to enter this strategy, which again, as you'll see, is most of the time very, very cheap. And so this is called the long put Christmas tree spread variation. So long, meaning we're going to be entering for a debit, so you're going to pay to enter the strategy. Put, because we're only going to be using puts. Let's actually switch over to puts. And then this is going to be a Christmas tree spread. And this is the variation because there's basically two different ways to set this up. And I've showed you one way. I'm showing you today the second way. And I'll show you how the other way looks here after we set this one up. So we're going to start by choosing an expiration date here. The idea is that the stock won't move much before that expiration. Again, this is a neutral strategy. You don't want the stock to move a lot. So I'm going to go ahead and I'm going to go to next week. Let's say I think next week the stock won't move a whole lot. And so the first thing you want to do here is you want to try and determine around what price you believe this stock will be at on the expiration. So what price do I think Rivian will be on May 13th? So let's say I think it's going to be around $30 a share, which is basically where it's at right now. So again, right, it should be a neutral strategy. You don't think it's going to move a whole lot. So what I'm going to do is I'm going to start by selling a put at that strike. So if I think it's going to be around $30 on the expiration, I'm going to start by selling a put. We're actually going to sell 3 puts here. And again, I'll show you how to modify the number of each contract here that you want. So we're going to be selling 3 of these puts. Now we're going to switch over to buy because now we're going to buy some puts. And so these strikes need to be pretty specific. So first we want to buy. First, we want to go up 1 strike, so to the $30, $50 strike, and we're going to buy 2 puts here. So I'm going to go ahead and click on here. We're going to be buying 2 puts at the $30, $50 strike, which is the strike right above it. And again, I'll show you how to modify the number of contracts we want here. Now what we need to do is we're going to go back to the puts that we're selling, which is right here. And we want to go down twice the distance as the distance between the puts that we're selling and the puts that we're buying. So the distance between these two is 0.5. Twice that distance is 1. So we go back to the puts that we're selling. We want to go down 1 strike. So that's the $29 strike. That's very important. Otherwise, this is not going to look how it's supposed to look like. Okay, we want to buy this put here now. Okay, so again, it's very important that you're choosing the proper and correct strike prices here. So now let's go back up here to this drop down. Let's go to custom. So again, the puts we're selling, we want to sell 3 here. So 3. And then the puts that we're selling with the highest strikes, the 30-50 strike, we want to buy 2 here. Okay. And so it's going to look something like this. So we're selling 3 puts and we're also buying 3 puts, but the puts we're buying, they have different strikes, right? 2 at this strike, 1 at this strike. So as you can see, total cost about $7, $4. This is going to change pretty quickly here. But as you can see, it can be very cheap, right? I'm talking $3, $4, $5 here. And obviously you can take a look down here as well at the P&L chart. Now, I've mentioned this before. The problem with looking at this is that this only tells you what it looks like on the expiration date. So it's very important to check or use option strat to visually take a look at what this is going to look like, depending on what date it is, depending on the share price, depending on implied volatility. So before I go over to option strat, let me actually just show you first what the other one looks like, right? So what the other version looks like. So this is what this one looks like. As you can see, it's kind of leaning towards the right. This is what the other one looks like. This one, as you can see, is leaning towards the left, right? So there are some differences here, but they're almost set up exactly the same. They're both using puts. So the one we're talking about here today is the variation. Let's go over to option strat and visually take a look at what this looks like. So let's go over to option strat. Let's go to build, and we'll just start with a long put here. And so again, we are using ticker symbol RIVN. And it's very important that you use this, guys, because again, this actually shows you what your trade will look like prior to the expiration, not just on expiration. And so we started by saying, okay, what price do we think Rivian will be on May 13th? We don't think it's going to move much. We think it's going to be at basically the same price it's at right now, $30. So he said, okay, we're going to start by selling 3 puts at that strike, at the $30 strike. Now we're going to buy some puts. We're first going to go up 1 strike, so to the 30-50 strike, and we're going to go ahead and buy 2 puts there. So we only want 2 here. And then we said, okay, now we want to buy 1 more put with a lower strike than the put that we're selling, and it should be twice the distance as the distance between the puts we're selling and the puts that we're buying. So again, the distance between these two is 0.5, twice that is 1. So we need to buy a put that's 1 strike away from the puts that we're selling. So that would be the one at the $29 strike, which is this one right here. So ultimately, this is what it looks like, okay? Net debit, $3. Max loss is $3. So again, you should be entering this for a debit, okay? $3, that's what we're paying. That's the most you can lose. So right off the bat, we see this is a very cheap strategy, or it can be a very cheap strategy. You don't need a lot of money to use this strategy. Now, if we take a look here, max profit, $97. So we're basically risking about $3 to potentially make $97, guys. Those are some pretty big returns. And we'll take a look at what that would be percentage-wise. And then we have our break-evens. So basically on the expiration, we want Rivian to be between 29.03 and 30.48 for us to make money here. And so this is what it looks like right here. As you can see, this is a neutral strategy. So number one, this is a very high reward to risk strategy. And the max profit, which is $97 here, you will make that if at expiration, the price of the stock is at the strike of the puts that you sold. So remember, the strike of the puts that we sold is 30. So if at expiration, Rivian is at $30, you can see that's where we would make $97. Now, how much would that be percentage-wise? Percentage of max risk. 3,233% return. if you were to enter this for $3 and make the max profit. That's a huge return, insane return. So this is a very high reward to risk strategy here. And the other thing, of course, to note here is that even prior to the expiration date, you can make some pretty big returns, right? 50, 60, 100, 200, 500, 600% returns here. You don't have to wait until it actually expires here to close out of it. You can close out of it anytime before the expiration date and take your profits here, guys. Now, the other thing, of course, we always want to check here is that what happens when implied volatility changes. So let's see, IV right now, 157%. So you can use the slider to visually take a look at what this would look like. So if IV goes down, this is what it starts to look like here. If IV goes up, this is what it starts to look like here, right? So as you can see, it definitely affects it both ways in, different ways here. So again, it's always very important to kind of visually take a look here, what's going to happen as IV changes here, right? But anyways, this is what it looks like right now. So anyways, this is the long put Christmas tree spread variation. Again, very cheap strategy here with very high reward to risk. But it definitely is a more advanced strategy, so be careful if you're a beginner. Anyways, if you guys have any questions about anything I just talked about, feel free to leave them in the comments section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I'll see you guys next time.